Good evening, friends. Hope you are well and doing fine. I, Ashok Kanawala, on behalf of HDFC Mutual Fund, extend a warm welcome to all of you on this call, Samvat 2082 Way Forward. Before we start the call, wishing all the viewers a very happy Diwali and hope that the coming year will bring a lot of peace, prosperity, and wealth to all of us. दीपावली की आप सब लोगों को बहुत सारी शुभकामनाएं और आशा करता हूं कि आने वाला समय आपके लिए सुखदायी हो, मंगलमय हो, प्रगतिमय. Before we start and I introduce the speakers for this call, I just want to show you one slide and then we can get going with the call. This is the scenario of two Diwali, in the sense just last September 30th and this September 30th. And you can see how the returns have been across the large cap, mid cap, small caps, and even gold, right? So if gold was last year around 29%, this year it is 51%. And small caps were outperforming large caps. This year, at least large caps on a relative basis are doing better than small caps. So one message which is coming out very clearly that asset allocation is key. Asset allocation बहुत अहम रखता है. We actually don't know. So this is 25. We don't know how it will work out on 26 pages. So discuss the current situation and the way forward. We have two eminent speakers, Navneet Munot and Chirag Setalvad, who needs no introduction. दोनों के बीच में 50 साल से भी ज्यादा का कैपिटल मार्केट का एक्सपीरियंस है, and I'm sure some of you would have heard them at various points in time. So without much ado, I now invite Navneet to make his opening remarks. And of course, after that, we'll have Chirag. And after Chirag, we'll open the floor for question and answers. And with me is my colleague, Ram Kumar, who will help me moderate the call. So without much ado, Navneet, over to you.
Thank you, Ashok Bhai. And on behalf of HDFC AMC, once again, I wish you and your loved ones a very happy Diwali and a blissful new year ahead. आप सभी को दिवाली की बहुत बहुत शुभकामनाएं. India is showing remarkable resilience amidst a volatile and challenging world. Our growth is higher than that of China. Our inflation is lower than Japan. The public debt, fiscal deficit, and current account deficit as percentage of GDP are lower than America, and forex reserves are higher than most of the developed and emerging countries. Over the last several months, we have seen a series of reforms by the government, proactive growth and market supportive policy initiatives by RBI, by SEBI, and one of the most powerful force underway in India, I would say, is digitalization. In a decade, we have seen India's transformation from the most data poor society to the most data rich society. Last year, on calls like these, we have specifically talked about valuation in equity markets. Whenever you heard me, you heard Chirag, you heard our other team members, they all talked about how pockets of markets where valuations had run ahead of fundamentals. And the result is markets had to undergo a period of consolidation. Ashok Bhai just showed you a slide which made that clear. I'm looking forward to hearing Chirag's views today on what he and team thinks of markets, particularly on the valuations today. I will just add one point. Last December, in my Person of the Year article, I talked about world standing at the cusp of a big new investment cycle led by investment in AI infrastructure, in climate transition, defense expenditure, supply chain diversification, etc. And one implication is we are seeing a frenzy in parts of the world investing in AI infrastructure. But I can clearly see a parallel with the internet boom of 90s where excessive investments in networking, fiber, and internet capacity elsewhere helped India in many ways in this century. And this time again, uh, possibly Indian and Indian companies can be a very big beneficiaries as AI adopters. Our fixed income team gave a call on decline in interest rates, and we have seen RBI actions in the last 1 year. That asset class is also looking interesting. We had multiple calls and notes on the importance of asset allocation from our team members, from Srinivas, who manages a couple of our hybrid funds, and also on the role of gold and silver in the portfolio. This has been one of the best performing asset class last year, but I would like to hasten to add here that investors should never extrapolate recent performance of any asset class and should always focus on right asset allocation and do the rebalancing in a disciplined manner. And of course, we will hear more from Chirag. I had the honor and privilege of chairing MFI, and along with our industry peers, we made huge strides in expanding the industry reach through enhanced transparency, through leveraging technology, and placing tremendous focus on investor education, taking mutual funds to real Bharat, taking to every household. And at HDFC AMC, as you know, our mission has been to be the wealth creator for every Indian, to be the wealth creator for every Indian. And all of us together won't leave any stone unturned to reach every household. At the beginning of this year, we celebrated 30 years of SDFC FlexiCap Fund. Last year, we celebrated 30 years of SDFC Balance Advantage Fund. My sincere thanks to all our partners, to all our investors for supporting us over these decades. FlexiCare Fund, I mean, a fund that has stood the test of time across many market cycles. We take pride in our people. We take pride in our well laid out philosophy. We take pride in our processes, in our research rigor, in our risk management, which is deeply ingrained in the investment process and not an after the fact activity. We've also built a strong alternatives and PMS platform, category two fund of funds, private credit, expanding the private equity capabilities, and both discretionary and non-discretionary PMS with a dedicated team of 17 investment professionals. Our Gift City feeder funds provide a great seamless access to non-resident and offshore investors. And I'm sure many of you partners who are present on the call who have investors outside India would be looking at these opportunities. Before I conclude, I must mention about one thing I've mentioned many times about the potential of AI. I strongly believe it is one of the most transformative forces in human history. And we are very happy that over 12,000 of our MFD partners participated in the AI training that we specially curated for you. We've been doing a lot, working very hard to better integrate and enable our partners from digital tools to enhance support systems. While investing heavily in next-gen technologies, we continue to expand our physical footprint with over 50 new branches opened over the last couple of years. We look forward to serving you better with next-gen technologies on one side, but along with the warmth of our people all the time. So thank you so much for your continued support and trust on SDFC AMC. Once again, my warmest wishes to you for Diwali and a blissful year ahead. As Ashok bhai said, हमारी शुभकामनाएं कि अगला वर्ष मंगलमय हो सभी के लिए and wish you all the very best. I really look forward to Chirag's insights on the economy, on markets, on fund positioning, and we'll open up for questions after that. So thank you so much, and over to you, Chirag.
Thank you, Navneet. Thank you, Ashok and Ram. And thank you most of all to all the participants who've taken the time to join us today. Let me start off by wishing you a happy Diwali and a very prosperous new year. We have a brief presentation for about half an hour where we will cover not only the economy, but also our approach to the equity markets and what is our perspective on the equity markets today. So let me start by sharing the presentation, which I will take you through. So the first part of the presentation will cover the economy, not only the Indian economy, but our thoughts on the global economy as well. And I think that is important because it is the economy which puts into context the environment in which the market is operating. The second part of the presentation will cover the equity markets and our perspective on large cap, mid cap, small cap sectors, and so on. And for the first time, we have a new section, which is the third part, which also talks about how we should broadly approach equities, the importance of asset allocation, the importance of thinking long term, the importance of being contrarian. So we have added that because that really is the foundation on which all investments must rest. But let me start with the economy. When you look at the Indian economy and you break it up into two parts, consumption and investments, we are actually seeing two very different trends. Let me take the investment piece to start with. Investments, which is roughly a third of the economy, is showing signs of moderating and slowing down. If you break up investments into three parts, government capex, household capex, and corporate capex, and let us examine how each of these is behaving. If you remember last year, the government started slow in terms of spending because of elections and monsoon and ended the year with strong capex. This year, it is the reverse. We see that the government has started off well, but over the next few months, and it's already visible, the capex that the government is incurring is likely and has already begun to slow down. In fact, in the first 2 months, the capex grew at 54%, and you can see that has already come off in the first 5 months to about 43%. The budget has budget expectations for capex is about a 10% increase, which means for the balance part of the year, capex is likely to actually fall by about 7-8% if the government is to meet its full year target of budget of 10% growth. State capex has also slowed down from the first 2 months where it grew at around 25%. In the next 5 months, we've seen that capex slow down to about 10% year on year. Household capex, which is essentially capex into real estate, has also moderated to some extent. Corporate capex is weak, and in an environment of uncertainty, in an environment of tariffs, it is unlikely that capex on the corporate front will pick up. Now, having said all of this, while capex is slowing down from the early part of the year towards the second half of the year, for the full year, certainly capex at 10% growth is still a reasonable number. I think the point we're trying to make is that is front-ended. Capex has started strong, but will end a little bit weaker. But still for the full year, while it is lower than what we have seen in the prior years, the capex is still reasonable, but is certainly on a slower note compared to the past. So on one hand, capex is slowing down. On the other hand, when we look at consumption, the story is a little bit different. Let us break up consumption into two parts, urban consumption and rural consumption. Urban consumption has been a little weak, driven by lower salary increases, the fact that personal balance sheets have seen higher leverage, and the fact that sentiment has been a little bit weaker. That has impacted urban consumption. On the other hand, rural consumption has been very strong. We see that nominal wage growth is running at 7%. Real wage growth, which is after subtracting inflation, is at about 5%, which is close to a 10-year high. Monsoons have been very positive, and NREGA demand has actually come down. NREGA demand comes down when the rural economy is showing buoyancy. So to summarize this, I think it's important to keep in mind that India GDP growth in real terms is still expected to be at 6.5%. That 6.5% number stands out when the US is growing at 2%, Europe is growing at 0.5%, and China is growing at 4.5-5%. So India stands head and shoulders above its peers from a growth standpoint. Within this growth framework, when you look at investments, as we pointed out, whether it is central or state capex, household capex, or corporate capex, that is slowing to some extent. But on the other hand, consumption, rural consumption. Over and above this, the government has put in a very, very large stimulus. It started with tax cuts amounting to almost 0.5% of GDP. Over and above that, we saw 100 basis points of rate cuts. We saw 100 basis points of CRR cut. And now more recently, we've seen a GST cut of about 0.5% of GDP. Over and above that, next year, we will have the impact of the revision in pay commission, which will add to another 0.8% of GDP. This 2.5 to 3% stimulus which the government is putting in place is genuinely unprecedented. It is a very large stimulus and will go a long way in boosting consumption. As consumption gets a boost over a period of time, there will be greater confidence on the capex front as well. To summarize this, we remain very confident on the Indian economy. When you compare India's growth to the rest of the world, it certainly stands out. We have one piece which is looking resilient, which is consumption, another piece which is lagging, which is investments. But when you put it together, overall growth in the Indian context still remains very impressive. And you can see that especially when you compare to what is happening outside of India. Outside of India, there is a lot of uncertainty, whether it is in the US or China or Europe. US GDP growth this year is expected to slow down to about 1.5% compared to 2.5% of last year. More importantly, this growth is being driven largely by AI. And the next slide will talk about the massive investments which are taking place in artificial intelligence in the US especially. So almost half of GDP growth, half of this 1.6% growth is been driven by AI and tech investments. So growth, while it is resilient right now, it is fairly lopsided. Unlike in India, where the growth is much more widespread, in the US, the growth is driven largely by one particular area. On the other hand, the labor market is slowing down and slowing down meaningfully. Payroll, which is the addition to the labor workforce, has come down dramatically. At the same time, the US is also facing challenges from an immigration standpoint. The labor market is weakening, and this has been noted by the central government over there. And we expect that the Fed will respond to this by lowering rates over a period of time. Inflation is also rising. We've seen core inflation has increased to about 3%, and this is before the full impact of tariffs has come in. So it is likely that inflation will pick up even further. So when you summarize the US market, while growth is still reasonable, it is driven by one particular sector. The labor market, which is an extremely important indicator of the health of the US economy, is slowing down. And at the same time, inflation is picking up. This is very different when you compare it to the Indian scenario, where growth is resilient and where inflation is very much under control. When you move to the Chinese economy, we are all aware that China has slowed down from the earlier growth rates of 9-10% to 4-5%. And there are question marks whether even this 4-5% numbers are reliable. Interestingly, we've seen exports in China and manufacturing in China, which are two growth engines there, has continued to do well despite the issue of tariffs. And the reason for this is while Chinese exports to the US have slowed down, those exports have been replaced by exports to other emerging markets, including India. So manufacturing and exports has been resilient, but the Chinese economy is facing a lot of issues, especially around the real estate sector. And inflation, in fact, in China, because of weak demand, has now moved into a deflation territory. Finally, we come to Europe, where things are fairly muted. GDP growth is less than 1%. The first quarter was close to 0.5%. The second quarter was hardly anything, almost flat. And tariff-related uncertainty will likely to keep growth subdued. So when you summarize this and think of the global environment, it is a bit challenging. US growth, while okay, is lopsided. US labor market is weakening. Inflation has picked up. Chinese economy remains weak. European economy remains weak. So it is a challenging global environment. And especially in such a challenging global environment, India's resilience of growth, India's temperance of inflation, and India's fiscal discipline and long-term prospects really stand out. We have put here some interesting charts of the global economy. So when you look at the global economy in pictures, and we've really tried to highlight the dependence, the remarkable dependence in the US of AI. In the last 1 year, or since the launch of ChatGPT, AI and AI-related stocks and tech stocks have contributed to 80% of price movement, 80% of growth, and 90% of capital expenditure. So really most, if not all of it, is coming from AI and tech. AI and tech requires large investments in data centers. It requires large investments in power facilities. So if you look at the middle chart here, you can see compared to office building expenditure, which is on its way down, actually electric power expenditure, which used to be close to office capex, is now 3 times that number. Data center capex, which used to be far behind commercial office capex, has now picked up. And the chart to the top right-hand corner shows you the dependence on AI investment as far as overall growth is concerned, and that almost 40 to 45% of GDP growth is attributable to AI. Now, while AI certainly has incredible implications for the future, I think the level of investments have been front-ended. And of course, while there will be winners and losers, I think the overall level of capex needs to be monitored to see if there is a slowdown, because that will certainly impact the US economy, because AI really is the pillar which is holding it up. On China, we wanted to highlight a few interesting data points. So the left-hand chart shows you that how, while exports to developed markets such as America and Europe and Japan have collapsed, they have been replaced more than adequately with exports to other emerging markets, including Mexico, Brazil, Thailand, Indonesia, and India. With that, I'd like to move on to the equity markets. And before we start on equity markets, I think it's important to keep in mind the conversation we had last year and how that conversation is changing as we enter this year. When we started last year, equity markets had done incredibly well, and especially mid caps and small caps were looking very expensive. Large caps were looking relatively better. Because of this valuation mismatch, our perspective was more positive on large cap than it was in mid cap and small cap. We were apprehensive due to the valuation excess in mid cap and small cap in terms of the outlook. Interestingly, that has played out as we expected. The markets have consolidated. We highlighted this last year that after 3-4 years of strong returns, it is to be expected that the market will go through a period of consolidation. I'm happy to say that period of consolidation has already picked up. We've seen a year where the market has been flat. And post this consolidation, valuations are now a lot more sensible across market segments. Certainly in large caps, but even so in mid cap and small cap, the extent of excess that we saw last year has seen significant moderation. So before we get into the charts and the graphs, the apprehension and the concern that we had last year, I will always be more concerned and apprehensive when markets are very elevated, and I will always be more excited and constructive when markets are relatively down or tepid. And hence, it is to be expected after a year of moderation that our enthusiasm on the market has actually moved higher. So let me delve into each of the subsegments of large cap, mid cap, and small cap. So to begin with, on large caps, the Nifty, which represents large caps, which is almost 60-65% of the overall market. So it's 2/3 of the market. Nifty premiums have now come down to as little as 8%. So broadly, one can say that Nifty premiums are in line with their long-term average. In fact, this year, India has been amongst the worst, if not the worst performing emerging market. As a result of that underperformance, India, which was trading at a premium to its peer emerging markets, is actually now trading at a discount. When you look at the P multiples, so the P's give us an indicator of valuations. When you look at the P multiples, which we have shown on the bottom left-hand side table, 1/3 of the market roughly trades at a discount, 1/3 of the market trades at close to average valuations, and 1/3 of the market trades at moderate premiums. And when you put that together, it corroborates our overall perspective on large caps, that large cap valuations are sensible, and hence a sector we are, or a segment that we are positive on. If you look at calendar year date performance, large caps have outperformed both mid caps and small caps, more so small caps. And now, post this moderation, 10-year returns seem to be a lot more sensible. Nifty 10-year returns are now close to 13%, mid cap returns 16% and small cap a similar number. So we have seen a reasonable moderation in long-term returns as well. India's share in world market cap is down 25% from its peak of 4.7%. We are now down to 3.5%. So to summarize, large caps continue to be better priced and a segment that we are positive on. When we started last year, it was a relative positivity. We preferred large cap to mid cap and small cap. I think today, it is fair to say it is not just relative positivity, but it is absolute positivity as well, because these premiums in valuation have moderated. When you go to mid caps, the story has changed quite a bit. Nifty mid cap 1-year premium, which last year in September had hit a high of 64% premium. That premium has now come down to about 19%. The premium has come down because the market is corrected. Prices are down by 6%. It is partly because the average has also moved up. And it is, of course, partly or largely because earnings have grown 18-20% in that period of time. Because of this 64% premium, which we observed in September, is now down to 19%. It's a much more sensible premium. This is the premium to mid-cap's own historical valuation levels. So mid-caps, compared to how they used to trade in the past, instead of being at a 60% odd premium, is now at a 20% odd premium. So it has moderated, and it is moderated meaningfully. When you compare mid-caps to Nifty, a similar story unfolds. You can see that the premium, which is the top right-hand corner of mid-caps to Nifty, has also moderated to a material extent. As a result of this moderation in premiums, we are more constructive on mid-caps than we have been in the past. Yes, there continues to be a premium of 19%, but I think a 19% premium is certainly a lot more manageable and digestible than the 60-odd% premium that we saw a year ago. Stocks have also corrected individually quite a bit. While the index may be off by 3-5% from the top, what we have shown you on the bottom left-hand table is individually stocks have corrected much more. Almost 50% of the index is down by more than 20%, and almost 25% of the index is down by more than 30%. Which means that while the index has corrected, individual stocks have corrected even more. And that presents a significant opportunity for people who are stock specific, such as ourselves. So when I summarize the mid-cap piece, valuations have moderated, and hence we are more constructive on this segment. Individual stocks have corrected even more, and therefore stock-specific opportunities have gone up. Yes, we are not in gung-ho territory, but we are certainly a lot more positive than what we were a year ago. We would like to see this premium ideally come down a little bit further. But when you look at it from a long-term standpoint, these premiums lose their relevance. If you are an investor for 10 years and 15 years, then a 15% premium can be fairly easily managed. When you go to small caps, interestingly, it's a similar narrative to mid caps. Once again, P's have moderated and premiums have moderated significantly. At one point, small caps traded at a 65-70% premium to their historical average. That is now moderated to 34%. We must keep this premium in perspective. We have seen ROEs in this segment move up. We have seen leverage come down. and we have seen disclosure standards improve significantly over the last many years. And hence, some premium to the past, I think, is justified. Over and above this, small caps are no longer the tiny companies they used to be in the past. 10, 15, 20, 25,000, all the way up to 32,000 crores of market cap is now considered to be a small cap. These may be small in name, but not in their businesses and their operations. So I think a 10% premium to the past, 10, 15% premium to the past is something which can be argued for. Today, they are trading at a 34% premium, which is a little bit higher than that, but certainly much lower than what we have observed last year. And hence, we are more constructive on the small cap segment as well. Small cap PE compared to Nifty correspondingly has also come off. And interestingly, just as we pointed out in the mid cap segment, while the index may be 8-9% off from the peak, individual stocks have corrected far more than that. Half the index is down by more than 20%, and a third of the index is down by more than 30%. The mid-cap universe has more than 2,000 listed companies, and individual companies have corrected significantly, and we find a lot more companies are interesting that we are evaluating today. So while small cap valuations are not back to average, and both small and mid for that matter are trading at a bit of a premium, we are a little bit more cautious as a result on small caps and mid caps compared to large caps. But while we are cautious, I think last year we were much more nervous and much more concerned. That concern and caution has come down because valuations have moderated and individual stocks have corrected. So today, this is an environment, I believe, in which one can continue to invest certainly in large caps, both in a lump sum as well as in a SIP format. And certainly in small caps and mid caps, one can continue to invest with a long-term perspective, so long as we have a tolerance for volatility and we are investing in a systematic fashion with a long duration perspective. Moving on to sectoral performance, it is interesting that the leaders of the past are the laggards of today, and the market has gone through a process of rotation. IT, healthcare, and power, which were the heroes of last year, are the relative underperformers of this year. In fact, metals and autos and banks have taken over from these sectors. Most sectors continue to trade at a premium, but that premium has come down quite a bit. Consumer staples, tech, and private banks are trading at or below long-term valuations, whereas metals, pharma, PSU banks, energy, and automobiles trade close to long-term average valuations. It really is utilities and industrials which are trading at a meaningful excess. We continue to believe that a stock-specific approach is warranted in this kind of environment. As we pointed out in the mid-cap and small-cap part of the presentation, individual stocks have corrected. So both from a stock-specific standpoint, individual stock-specific standpoint and sectoral standpoint, we prefer to drill down to individual companies to add value to our portfolios. I think it's a good point to also address how ownership has changed over a period of time. We have seen significant change in ownership in the last few years. We all know that SIP book has been very robust. Domestic buying has more than offset foreign selling. The last 2 years, we've seen about $100 billion of buying by domestic institutions, mutual funds, and insurance companies put together, compared to about $20 billion of selling in those 2 years. As a result of this, for the first time that I can remember, the ownership of DIIs has crossed the ownership of foreign institutional investors. And this is a very meaningful event because the domestic institutional investor money tends to be much stickier, and it is India-centric, it is India-dedicated, it tends to be a lot less fickle, and that gives the market a degree of stability which possibly wasn't there in the past. Interestingly, retail investors continue their preference for mid-caps. Nifty, which used to be almost 50, this is the bottom left-hand chart. Nifty, which used to be 50 to 55% of retail investors' portfolio, that has come down to about 35 odd percent. Almost 2/3 of retail portfolios is now mid-cap compared to half some time back. The middle chart at the bottom shows you the importance of mutual funds. Mutual funds now own or more than a 5% stake in 75% of NSE 500 companies. This compares to 35% a decade ago. So the mutual fund ownership of Nifty 500 companies, of mid-cap, small caps, has certainly increased. And this gives stability not only to the overall market, but one can argue greater stability to mid-cap and small cap. It is not that the fundamental nature of these market cap segments will change. Mid-cap and small cap will remain more volatile than large cap, but possibly there will be a little bit more stability compared to what we have seen in the past. Mutual fund flows continue to be robust, which is what you can see on the right-hand side, and cash holding in the mutual fund space is roughly 6-7%. We all know the IPO market has been robust, and just last week we've had some blockbuster listings. So it is relevant to put in place some of the numbers. Last year, the primary market, IPO market, raised $40 billion. This year, we have already raised $20 billion. Over and above that, there is a pipeline of issues which have been announced already, which is another $30 billion. So if you add that in to the current issuance of 20 odd billion, we have raised almost 60, 70, 80 billion dollars in the last 2 years. It's a very, very large fundraise. What is interesting though is a lot of these issues are now getting receptions which are not as ebullient as in the past. So last year, we would see very often that issues would list at gains of 24, 25, 30%. That is now moderated to 10, 15%, which means that IPOs are getting priced in a fashion which is leaving 10, 15% on the table. Promoter stake sales have actually remained robust. So promoters have been selling roughly $10 to $15 billion every year, and that continues this year as well. The point of this slide is to highlight that the IPO market continues to be robust and the issuance level continues to be high. And that in fact reflects the overall excitement that persists in the market today. Let us quickly talk about global valuations and then we will move forward to the third part of our presentation. Global markets have done extremely well, and as a result, pretty much all markets trade at a premium to their long-term average. That includes Europe, America, China, Japan, Asia ex-Japan. All of these are trading at moderate premiums, not significant, but moderate premiums to their long-term averages. In fact, India has been amongst the worst performing emerging markets this year. Most commodities have actually underperformed as well. Barring precious metals, silver and gold in particular, and other than that, copper, most other metals have been underperformers, whether it is coal, whether it is crude, whether it is agri, steel, etc. Commodities being muted is good from a longer term perspective from a margin standpoint. But the idea of presenting this slide is to highlight that it is not just India which is trading at a moderate premium, but it is markets globally because of the surfeit of liquidity, not only in India but outside of India, that most markets trade at a premium, and India is similar to those markets in that sense. So let us summarize what we have spoken about so far. I think it is very important to keep in mind that India's growth compares extremely favorably to the rest of the world. Consumption, which is the bulk of the economy, while the outlook is mixed, currently, we think that things will improve. Rural consumption is doing very well. Urban consumption might be weak, but because of the massive stimulus the government has put in place, we think consumption will certainly pick up, and that will support overall economic growth. CapEx is weakening, central and state CapEx, and that is something that we have to be watchful of. Household CapEx, which is CapEx into real estate, continues to be moderate or is likely to be moderate after a very strong year in real estate. IPO pipeline is large, but India's valuations, which are above average, which continue to be above average, have moderated quite a bit from their peak. Globally, growth is slowing down, inflation is picking up, and I think we need to be very watchful of how AI and tech unfolds. It is half of US growth and a big driver, 80% driver of stock market performance. Valuations globally continue to be at or above long-term averages. With this, I come to what I think is actually the most important part of the presentation, which is key success drivers. The first and most important being asset allocation. And Ashok referred to this at the beginning of his presentation. Always keep in mind that over a longer period of time, equity market returns tend to be strong in the mid-teens versus fixed income, which tends to be in the mid-single digits. And therefore, how much money you have in equities versus how much money you have in fixed income is the bigger driver of portfolio returns. It is more important to figure out how much you want in equities versus fixed income or debt, as opposed to spend time selecting individual funds within equities or within debt. Get your overall asset allocation right. That will depend on your age, that will depend on your liquidity profile, that will depend on your risk appetite. But asset allocation is the key driver of portfolio returns. I find that investors spend a lot of time and attention on fund selection within these categories, but very often get the overall allocation to the category wrong. So please focus on asset allocation. The second and most important is invest for the long term. The longer, the better. In the insurance industry, we invest for a lifetime and beyond. And yet, when we think about mutual funds, we invest for 1 year, 3 years, 5 years. When we start talking about 10 years, people think that is too long. In fact, we should be thinking of 5, 10, 15, 20, and 25. The longer you invest, the greater is the power of compounding. In stock markets, there are only 2 mistakes one can make. Investing when the market is too high or selling when the market is too low, or a combination thereof. Even if one makes these mistakes, but if you hold long enough, the power of compounding will mitigate those mistakes to a material extent. All investors I know who have made meaningful money have made it by holding on. It is not timing the market that is important, but time in the market, which is far, far more important. At the same time, one should also have a contrary bent of mind. Invest more aggressively when the market is nervous and the environment is more challenging, and vice versa. For those who invested at the bottom of the financial crisis and those who invested at the bottom of COVID, returns have been spectacular. Investing in tough markets is by its very nature difficult, but is a very rewarding exercise. We are unfortunately in a world which sees crisis more often than it should. The next time a crisis hits markets, it is important to remember that investments made in crisis periods reap fantastic rewards. And while contrarian investing is an important element of portfolio strategy, the key and fulcrum remains on systematic, consistent SIP investing. Let me give you an example of the importance of remaining invested through the returns of our FlexiCap fund. The FlexiCap fund has been around for 30 years. In that 30-year period, our 1 lakh rupee investment has grown to 2 crores. But unfortunately, of initial investors who started in the FlexiCap fund, less than 1% of investors continue to be remaining as investors today. A lot of investors have come and gone at different points of time. But for those who invested for that entire period, the returns of 18.5% compounded has resulted in a massive amount of wealth creation. A lot of investors think that timing the market is appropriate or can lead to better returns. But let us look at this example of FlexiCap Fund. Since its inception, it has given a return of close to 19% CAGR. If you were invested for all days, if you decided to time the market and got unlucky and missed the best 30 days, that is the best 30 days in 30 years, your return falls from 18% to 12%. The index return in that same point with the same timing would fall from 14% to 7%. So just by missing 30 days of a period of 30 years, because of timing, returns can fall substantially. So I would encourage you to focus on asset allocation, be contrarian, invest for the genuinely long term, and use SIPs as a key tool, but not time the market, but keep your money in. With that, we'll come to our last slide. Very often investors ask us what works. And I think it is personality, which is far more important than IQ or intelligence. Be independent. While it's important to hear others, I think very often we know the answer ourselves. It is very easy to get carried away with the enthusiasm and despondency of crowds. So try and be independent. Be careful and skeptical in terms of what others say. Have a contrarian bent of mind. Don't follow the herd. When the market has fallen and people are scampering, that is the time to increase investments. And when everybody is doing well and touting that the market is the next greatest thing ever, be more careful. Genuinely be long-term and patient. It is extremely rewarding. It is far better to be lazy than hyperactive. Fill and forget. Keep things simple. For those who are investing directly into stocks, invest in those businesses which you can understand well. Don't get carried away with trends, fads, guidance, and what others are saying. And lastly, of course, hard work has no substitute. There are thousands of people we are competing against, and therefore it is incredibly important that we analyze thoroughly and ask a lot of questions. With that, I come to the end of my presentations. I sincerely wish everybody a very happy Diwali and a prosperous new year. Thank you, and I will hand it over to Ashok.
Chirag, that was indeed a very comprehensive presentation. You covered Indian economy, some part of the global economy, of course, number 1 and 2, US and China. You covered the valuation, relative valuation of each market cap. And finally, your words of wisdom on the behavioral part of the investments, importance of asset allocation, contrarian. I think this presentation had everything that anybody would like to have from you. It was indeed super. I will just again share my first slide, and because that's a lot of things which we just discussed about asset allocation is, while equity returns have been, a bit disappointing, I would say last 1 year, if you see. But in last 1 year, a lot has happened. Of course, we started last year when Diwali call was there, I remember. We sounded that valuations are a little bit expensive. So there was a valuation concern. But between those valuation concern of that time and right now, a lot has happened in this country. We had a record FI outflows. We had this tariff saga happening here and there, geopolitical tensions. And I think despite all this thing, I believe that we are holding quite well. So having said that, Chirag, now if we think that the markets are efficient, how do we read the markets from here on, in the sense that what are the further risks that we can think of from a market perspective that the investors should be aware of, that this can be the risk? Because I think lots and lots of course, we can't, forecast what can be coming. It's always uncertainty. But what do you think are the risks that investors should be aware of? Because we have seen, I think we've digested also all kinds of geopolitical activity, tariff, etc. And we are Today, as we speak, we are very close to all-time high once again. That after whatever 12, 13 months of period that is elapsed. So what do you?
So, Ashok, I'll be very honest. As Indians, we think of the opportunity as within India, and we think of the risks also to be largely within India. But the reality is, the Indian market is part of a global ecosystem, and they do, certainly in the short term, move in fair tandem. I think the big risk to me today is not really India, but it is outside of India, and especially in the US. That is an economy which has done incredibly well. That is a stock market which has done incredibly well. And that accounts for 40-50% of global market capitalization. The reliance there on AI is very significant. While the promise of AI is fantastic, it is not clear whether investments are being excessively front ended, which means if there is disappointment in capex and in the outcome of AI, then we could see those stocks correct, and even for that matter, a meaningful impact on overall GDP growth. So I would keep a close watch on how AI pans out. I think there is a lot of excitement. And my observation, simple observation, has been in the past, in whatever area, I'm not an AI expert, but in whatever area there is over enthusiasm and over excitement, it sows the seeds for disappointment over a period of time. We saw that in the power sector in India 7, 8 years ago, 10 years ago. We saw that in .com. We saw that in electric cars. We saw that in renewables. All of these, many of these had strong merit, but the expectations were too high. And high expectations in most aspects of life, including the stock market and the economy, leads to disappointment. So I think that's a key area. I think the tariff issues will settle down as the year progresses. I think India's growth remains strong. I think the valuation premium, which has moderated, that risk has reduced, but is still on the table to some extent.
So coming to the markets once again, that uh, clearly you said somewhere the capex seems to be moderating, but government is focused on reviving consumption as a theme, and couple of things that you spoke about: CRR cut, interest rate cuts, tax cuts. So government is focused on driving consumption. So what would be your advice to investors that should they be going out is a natural thing about the diversified funds, which takes care of all the sectors, or there's a case right now to allocate something towards consumption-based themes that are available in the market, or for that matter, even innovation-based themes which are there in the market. What would be your advice to such investors?
I think there are actually several funds, Ashok, which I would recommend today. And this is all, I think the caveat I would like to put in place before answering that question is that is all from a long-term standpoint. I'm not talking about the next 1 year. I'm talking about the next 5, 10, or 15 years. Those are the time horizons I'm looking at. I think consumption, for sure, as one, is a theme, I think, which will certainly gain momentum. Investments are slowing down, consumption is picking up, and we have massive stimulus in place. And at the same time, valuations, while they may not be cheap, from a relative standpoint, consumer staples valuations are better compared to other sectors. They're not cheap in an absolute sense, but in a relative sense, they're still okay. And I think there is a risk and possibility that earnings will improve quite substantially. So I think that is certainly one area. I continue to believe from a long-term standpoint, and the short term is quite different from the long term in this case, but I think from a long-term standpoint, I'm a big believer in the small cap category. I think the number of stocks which are available, the opportunity to add value to portfolios through stock selection is fantastic. I would be careful because the long term and the short term views are a little bit different here, because I think in the short term, I'm still concerned, though less than I have been in the past, because valuations, while they are moderated, are still at a premium. But from a long term standpoint, I think that category still has a long way to go. So I think that would be another. I think from a thematic standpoint, innovation is a very interesting sector. AI and all the other innovation which is taking place not only outside of India but within India I think there are some fantastic opportunities which are arising, and you can see that in companies which have been listed more recently as well as in the past. We can't get stock specific here, but we see a tremendous growth opportunities, whether it is in quick commerce, whether it is in a number of other interesting areas where innovation is certainly playing a key role. And we have a fantastic manager who looks after it, Amit Sinha, both the consumption fund for that matter, as well as the innovation fund. And I think he has a very good handle on stocks. And I think those funds over a longer period of time can also do well, along with the small cap fund. And the last I would add to this is a large cap portfolio. And you can choose large cap or flexi cap. I think both of them work. Those tend to be good anchors for the portfolio where you can put in, 50, 60, 70% of your portfolio over a period of time. Flexi cap obviously gives you the ability to move from sector to sector. Large cap gives you the stability of large caps. That, along with small caps and the thematics that we have mentioned, I think can give a well-rounded off portfolio.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.